In June 2019, 300,000 people tried to get their money back from Britain's most famous investor. The fund froze. The money was locked. Some of them waited years to see what was left of it. His name was Neil Woodford. For 2 decades, the press called him the man who couldn't miss. £10 billion flowed into his fund, and the people who sent it believed the most expensive sentence in finance. The professionals know better. Quick note before we start. This is education, not financial advice. The numbers here are uglier than almost anyone admits. Here is the deal you've been offered your whole life. Somewhere out there is an expert. He watches the markets all day. He has research, experience, connections you'll never have. Give him your money. Pay him a small fee, 1%, maybe a bit more, and he'll grow it better than you ever could. 1%. It sounds like nothing. A tip you'd leave without thinking. And that 1% is the most profitable lie in modern finance. It takes around 1/5 of your lifetime wealth in exchange for a service that fails almost every time it's measured. Strong words. Let's earn them. Start with the fee itself, because almost everyone reads it wrong. 1% does not mean you give away 1% of your money. It means you give away 1% of your entire portfolio every single year, forever, no matter how the fund performs. Watch what that does over time. You invest $100,000, the market gives 7% a year, and you stay invested for 30 years. In a cheap index fund charging almost nothing, you end up around $720,000. Same money, same market, same 30 years. But inside a fund charging 1%, around $574,000. The difference is roughly $150,000. That is a house deposit. Years of retirement, gone, without a single bad market day. Why so brutal? Because fees compound exactly like returns do, just against you. The €1,000 the fund takes in year 1 isn't just €1,000. It's €1,000 that would have kept growing for 29 more years. That single year's fee ends up costing you around $7,000, and the fund takes a bite like that every year. Run the full math, and paying 1% instead of 0.1% surrenders roughly 22% of your final wealth. 1/5 of everything. For a number that sounds like a rounding error. And 1% is the friendly version. In the real world, fees stack. The fund charges 1%. The platform takes 1/4. An advisor adds another one on top. Plenty of ordinary savers are paying 2% all in, and have never once added it up because every layer looked small on its own. At 2%, the math stops being a leak and becomes a partner. Over an investing lifetime, costs like that can claim 1/3 or more of everything your money earns. You take all the risk. They take 1/3 of the result. That's the deal, printed in a font nobody reads. Now, maybe that's fine, maybe it's worth it. 1/5 of your wealth for a professional who beats the market. Genuinely, that could be a fair trade. So does he beat the market? This is the best documented question in all of investing. The answer has a name, SPIVA, 25 years of scorecards, published by S&P, counting how many active funds actually beat their benchmark. Over 15 years, almost 90% of large-cap fund managers in America failed to beat the S&P 500. Not underperformed slightly, failed to beat the index you can buy for nearly free. Morningstar ran the same test over 10 years and found 92.7% underperforming. And across 22 categories of U.S. equity funds, there was not 1 where most professionals beat their benchmark over 15 years. Read that again. In no category did the average professional earn his fee. And here's the uncomfortable reason why. It's not that fund managers are stupid. Most of them are brilliant. The problem is that they're competing against each other. The professionals are the market. For every trade one manager wins, another loses. Before costs, the average professional earns exactly the market's return. It's arithmetic, not opinion. Then the fees arrive. Same average return, minus 1 to 2% every year, which means the average professional doesn't just fail to beat the index, he's mathematically guaranteed to lose to it as a group over time. The scoreboard isn't an accident, it's the only possible outcome. At this point, someone always says, sure, the average manager is mediocre. That's why you pick a good one. Look at the track record. This is where it gets genuinely dark, because S&P also tracks whether the winners stay winners. They took every U.S. equity fund that ranked in the top quarter in 2021 and checked who was still in the top quarter 5 years later. The answer, 0.46%, not 46%, less than half of 1%. And among large-cap funds, the exact place most people invest, the number was 0. Not one single top fund stayed on top. A track record tells you who got lucky recently. It tells you almost nothing about what happens to your money next, which brings us back to the man with the best track record in Britain. For 25 years at Invesco, Neil Woodford's numbers were extraordinary. He dodged the dot-com bubble. He sidestepped the banks before 2008. The BBC called him the man who made Middle England rich. When he launched his own fund in 2014, it raised over £1 billion in weeks, the biggest launch in UK history. At the peak, $10 billion. Savers didn't just buy a fund. They bought the story, the star, the track record, the professional who knows better. And the industry sold it hard. Britain's biggest investment platform kept the fund on its best buy list almost to the very end. 130,000 of its customers were inside when the doors shut. Best buy lists, 5-star ratings, Manager of the Year awards. All of it built on the same raw material, past performance. The one thing we just saw predicts nothing. Then the picks went wrong. Step by step, the star had drifted away from the solid dividend companies he was famous for into small, hard-to-sell startup bets. Performance sank, investors started leaving, and to pay them out, he had to sell the good stuff first, leaving the rest even more stuck. In June 2019, the fund froze withdrawals. 300,000 people locked out of their own savings. The fund was wound up, the assets sold off over years. The regulator later set up a compensation scheme worth up to £235 million, and in 2025, fined Woodford and his company around $46 million, banning him from managing money for ordinary investors. Every one of those investors had seen the same track record you would have seen. It was real. It was 25 years long. And it predicted nothing. Here's the question that actually matters, though. If 9 in 10 professionals lose to a cheap index fund, what exactly is your 1% buying? Mostly, it buys marketing, star managers on magazine covers, glossy reports, an office with a good address. The fee is not the price of performance. The fee is the price of the story, the comforting feeling that someone smart is at the wheel. And the industry needs you to feel that, because the fee doesn't care whether you win. Your fund can trail the market for a decade, and the 1% still flows out of your account every year, like rent on a flat you don't even live in. Now, before this becomes a rant, the honest other side, because there is one. Some of what good financial professionals do is genuinely worth paying for. A real advisor who stops you from panic selling in a crash may save you more than any fee. Tax planning is real value. Retirement math is real value. If someone charges you for coaching, planning, and discipline, that can be money well spent. The lie is narrower and sharper. The lie is paying premium fees for market-beating stock picking. That specific product, the one the whole industry was built to sell, fails the test in 90% of cases, and its winners can't be identified in advance. Not by you, not by anyone. Even Warren Buffett, the most famous stock picker alive, put this in his will. When he's gone, his wife's money goes into a cheap S&P 500 index fund. The greatest active investor in history looked at this exact math and chose passive for his own family. He didn't just say it. He bet on it. In 2008, Buffett wagered $1 million that a plain S&P 500 index fund would beat a hand-picked collection of elite hedge funds over 10 years. The finest, most expensive money managers on the planet against a fund that does nothing. The index won by a landslide. The hedge fund side conceded before the decade was even over. So here's what you actually do with this. First, find out what you're really paying. not the number in the brochure. The total, fund fee, platform fee, advisor fee. Stack them up. Plenty of people are paying 2% all in and have never once added it up. Second, make the fee justify itself in writing. If someone charges 1%, ask them, what exactly do I get that a nearly free index fund doesn't give me? If the honest answer is planning and hand-holding, decide what that's worth. If the answer is we aim to beat the market, you've seen the scoreboard. Third, stop hunting last year's winner. The top quartile trophy shelf gets completely rebuilt every few years. Chasing it is buying lottery tickets with a management fee attached. And fourth, remember the only lever that's fully in your hands. You can't control returns. You can control costs. Every point of fee you don't pay is a guaranteed, risk-free, compounding return, the only one that exists. One line to take away. Nobody cares about your money as much as the people charging you for it, and their favorite customer is one who never does this math. Woodford's investors learned it the expensive way. The SPIVA scorecard proves it every single year. Now the math is yours, which means the 1% needs a better argument than a smile and a track record. If this saved you money today, subscribe. Next time, we take apart another comfortable story the finance industry sells you. And tell me below, do you know, right now, exactly what you're paying in fees? Be honest, I read everything.